Welcome to The Explainer, everyone. Today, we are diving into an absolutely fascinating, high-stakes situation surrounding one of Europe's most systemically important financial giants, BNP Paribas. If you've been keeping an eye on the markets, you know this bank has been making some serious headlines lately. But look, this isn't just your standard story about a bank making money. It's actually a story about a fundamental powerhouse locked in a massive tug-of-war with some very heavy macroeconomic shadows. On one side, you've got stellar operational performance and literally record-breaking profits. But on the other, a really complex web of political uncertainty and regional risks. So we're going to look closely at the source data today and break down the bull versus the bear case. Let's get into it. Here is our roadmap for today's breakdown. We'll hit the earnings powerhouse, the AI-driven future, something called the France discount, a few company-specific headwinds, and finally, the valuation verdict. Starting right off with Section 1, the earnings powerhouse. Okay, so starting with the micro-success story here. In Q2 of 2026, BNP Paribas posted a massive 33.4% year-on-year jump in net income, hitting a staggering 4.345 billion euros. And when you dig into the underlying data, you see this isn't just a one-off anomaly or some clever accounting trick. This massive jump was fueled by 12% revenue growth across all of their major divisions. The absolute standout, though? Equity and Prime Services, which saw a record 43% revenue surge. But what's absolutely crucial to note here is their operating leverage. Their revenue grew at 12%, right? But operating expenses only grew at 10%. That tells us management is doing a fantastic job keeping a tight lid on costs while their top-line growth is just firing on all cylinders. And here's the best part, if you're an investor, that operational success translates directly into your pocket. The bank is rewarding shareholders with 60% of its first-half earnings. Specifically, we're talking about a 50% dividend payout alongside a 10% share buyback program. That interim dividend of 3.23 euros per share, it actually yields a highly attractive 5% at current prices. In today's interest rate environment, finding a 5% yield that's this well covered by surging earnings is a very compelling piece of the bull case. And just to prove how well covered those returns actually are, let's take a look at their capital position. The all-important CET1 ratio, which, if you aren't familiar, is basically the ultimate measure of a bank's financial fortress and its ability to withstand stress, hit 13.0%. Now, what makes this so impressive isn't just the number itself, but the timing. They reached this target a full 18 months ahead of their 2027 schedule. Management has already signaled that any excess capital sitting above this threshold is going to be increasingly directed toward even more buybacks. So yeah, calling this a powerhouse right now is almost an understatement. Moving right along to Section 2, the AI-driven future. Looking at their strategic timeline, we're currently sitting at this Q2 2026 milestone of record earnings and a deep AI rollout. But if we look out to the horizon, it points squarely to 2030, where the bank has set a massive €1 billion annual cost-saving target. To get us there, CEO Jean-Laurent Bonnafé has confirmed that a brand new 2030 strategic plan is in its advanced stages and will be officially unveiled in February of 2027. This plan is going to map out their next phase of growth, as well as a big expansion into sustainable finance. Zooming in on that €1 billion target for a second, the source data reveals something wild. Artificial intelligence is expected to deliver roughly half of those savings by 2030. We constantly hear AI thrown around as a vague buzzword these days, but here, the tech is a quantified, massive financial driver that's acting as the main engine for margin expansion over the next 4 years. It's a real game changer for their bottom line. Let's look at how this actually plays out on the ground. In Belgium, for example, BNP is using AI and automation to essentially replace the work of 1,000 employees over a 3-year stretch. But listen, the strategy isn't just about ruthlessly cutting headcount. It's really about process re-engineering for speed, accuracy, and ultimately better client service. This shift is expected to drive a 2 percentage point annual improvement in their cost-to-income ratio starting in 2027. And running parallel to this efficiency drive is their big sustainability push, highlighted by a recent €250 million guarantee from the European Investment Fund under the InvestEU program. That's designed to mobilize financing for green companies. So it's a two-pronged approach: hyper-efficiency internally, and forward-looking sustainability externally. Now, for Section 3, the France discount. So you might be wondering, with all these incredible fundamentals, why isn't the stock price rocketing to the moon? Well, to understand that, we have to understand the bear case, and specifically the France discount. This is a term used to describe the premium investors are demanding right now simply for holding French assets. France is heading into a highly critical presidential election cycle, As different candidates float various fiscal measures, market observers have raised flags about the country's already high public debt. So regardless of where you stand politically, the market fact is that this fiscal and political uncertainty creates a tangible drag on asset prices across the board. To put that concept into perspective, we just have to look at recent market action. On August 26, 2026, BNP Paribas shares fell by up to 4.4%, dropping right alongside other major French banks. Why? Because that political uncertainty pushes up the spread between French and German government bonds, which is a primary indicator of country risk. And since BNP Paribas naturally holds a massive portfolio of French government bonds, these widening spreads mean higher funding costs for the bank and potential mark-to-market losses. It is basically a huge macroeconomic storm cloud sitting right over the bank's microeconomic parade. Let's pivot to Section 4, Company-Specific Headwinds. Beyond the macro picture, they do have a few operational speed bumps right now. First up, their integration of AXA Investment Managers carries about 800 million euros in restructuring costs expected this year. Yes, they're one-off expenses, but they're absolutely going to weigh on short-term earnings. Second, their Arval leasing division is currently taking a hit from falling used car prices, which hurts the residual values of their fleet. That's a trend that's expected to persist into 2027. And finally, we have regulatory headaches, like the October 2024 indictment by South Korean prosecutors over alleged short-selling rule violations. While that's an older issue, it really just highlights the constant regulatory friction of operating a massive global investment bank. Add to all that the constant swirl of market chatter. Just yesterday, on August 26, 2026, the bank had to officially step out and deny market rumors that they were interested in acquiring a stake in Vietnam's Techcombank. While a simple denial clears the air, these types of rumors add unnecessary volatility to a stock that's already navigating a really tricky, complex environment. Which brings us to our final section, the valuation verdict. So what does this all mean? How does the market actually price this fundamental powerhouse that's currently trapped in a volatile environment? Right now, BNP Paribas trades at a price-to-earnings ratio of about 8.8 times earnings. Compare that to the broader European banking industry average, which is sitting way up at 11.9 times. The stock is undeniably cheap compared to its European peers, and it's also trading well below the broader French market average. The French discount is very clearly baked right into these numbers. But because the underlying fundamentals are just so strong, major investment banks see serious room for growth if those macro clouds ever part. Looking at the analyst consensus, Auto BHF and Goldman Sachs both have price targets set at 105 euros. UBS is slightly more bullish at 111 euros, and the overall analyst consensus price target lands at 113 euros. So all of these major institutions are implying moderate to significant upside from where the stock is trading right now. And that really summarizes the core tension of our explainer today. On one hand, you have a classic fundamental buy story. You've got 33.4% income growth, aggressive AI efficiency, and a massive 60% cash return to shareholders. But on the exact opposite side, all of that is completely overshadowed by macro-political headwinds. The France discount, widening bond spreads, and those internal restructuring costs. It is literally a battle between micro-strength and macro-gravity, which leaves us with the ultimate question for anyone watching this space. Until the political uncertainty in France actually stabilizes, this stock is almost definitely going to remain volatile. So, do the stellar internal fundamentals present the absolute ultimate entry point for a long-term investor with a high risk tolerance? Or if you've got a shorter horizon, will that geopolitical anchor and fiscal concern just keep holding BNP Paribas down, making it smarter to just wait for clarity? The fundamentals completely support a positive outlook, but for sure, right now, the macro environment is dictating the timing. Thank you so much for joining me for this explainer, and definitely keep your eyes on how this tension resolves over the coming months.